Very good afternoon, everyone. So I'm Vasan Errakiah. I'm the Managing Director of Pacific Life Re in Asia. Very pleased to be here among distinguished guests, friends from the industry and colleagues. And I'm also very pleased to share the stage with esteemed veterans and professionals from the industry, Mr. Gaston, Sunayana, and also Mr. Sateesh. And before we start the panel discussion today, please allow me a couple of minutes to set the scene for you on what exactly we're going to be covering and what exactly we're going to be discussing today with you all. Now, when we talk about reinsurance, traditionally it's always been thought about as risk transfer tool, purely risk transfer. But I'd like to challenge that thought today here with a bit of a provocative thought. What if reinsurance disappeared tomorrow? What do you think will the industry look like? Will it just be purely from a risk perspective? What about earnings profile? What about decisions that senior management and boards make? Would you still launch the same products? Would you still look after the segments that you're covering today? Or would you make very different decisions? Now, as you think through those questions, allow me to reiterate my point that traditionally we have thought of reinsurance as pure risk transfer, a safety net, a technical necessity. However, the truth is it has evolved to be far more than that. It has become an integral part of strategy. And today we are entering an era of significant changes. You see evolving climate risk, evolving natural disasters. There's increased use of AI models in decision making. There's increased use of digital underwriting. And there's intensified competition in India that means we are now looking at new segments, new risks. So what does this all mean? Risks are becoming more complex. Volatility is no longer the same. It's becoming more complex. And capital is no longer cheap or will not become cheaper. So the winners will not be those who maintain the status quo. In fact, the winners will be those who truly understand risk and deploy capital in a very effective and efficient manner. Now, reinsurance sits at that very intersection. We're not just a safety net. We're a strategic lever that can be utilized to support growth. Now, my last point before I start off the panel discussion is just to drive the point home. I look at a complete tangent, different industry. So let's look at rockets. I know it's not quite insurance, and I'm not comparing us actuaries to rocket scientists. However, I would like to make that comparison. But if you look at what NASA did, and most of you know NASA, the National Space Agency in the US, when they started building rockets, they owned everything. They owned the infrastructure, the technology, the launch risk. And that was the model they operated in. But then came along SpaceX. Most of you know SpaceX, was founded by Elon Musk. Did things very differently. Structured risk, infrastructure, launch risk, all very differently. Financing risk, very differently. And what has that done? That has enabled growth at a much faster pace. Innovation at a much faster pace, to the effect that has overtaken NASA in terms of its technology. Now, reinsurance plays a similar role for the insurance industry, and that's my view. We are more than just a safety net. We are a strategic lever. So the question here today is, are we treating reinsurance in the same way as SpaceX did? And so hopefully with that context set, I'll start kicking off the questions. And in the meantime, the organizers, if you don't mind putting up the poll on screen, that would be great. So the first question is to Ms. Sunayana. So do you see reinsurance primarily as capital relief, earnings smoothing, tail risk protection, or growth enabler? And which do you think dominates in India?
Thanks, Vasan, for the question. I would say reinsurance plays a role in all four, but in a moment I'll come to which I think is the dominant provider. Reinsurance has definitely played a role in capital relief, right? There is so much of new business strain. So after the insurance sector got privatized in 2000, for the last 20-25 years, insurers have been growing and have required a lot of capital for that growth. Part of that capital has also been provided in form of reinsurance by taking risk off companies' balance sheets so that they could invest in higher growth. There has also been a role played by reinsurers in earning smoothings. Today, we are able to write 100 crore life covers. I'm sure on the PNC side, Sateesh can speak more, but we are definitely able to insure much larger properties, factories, because there's a reinsurer backing the balance sheets, right, and smoothing out the earnings. Tail risk protection, I don't think I need to talk a lot about that. We've just fresh from the scars of COVID, and we know the crucial role played by reinsurers in such a tail risk event. But I would say the most dominant reason for reinsurance today in India is growth. India's insurance market is growing close to 7% in real terms annually. That's much ahead of developed markets like US, much ahead even of China. So being one of the largest, fastest growing insurance markets, growth is where the highest support comes from reinsurance. You see growth in terms of the number of products, growth in the types of products, growth in risk appetite, sums assured. In each and every aspect, when you come, there are so many foreign delegates today. They have come because they are seeing India as one of the highest growth markets. And reinsurance is playing a crucial role in taking new business strain off insurers' balance sheets and providing them with the fuel to grow business.
Thank you, Ms. Sunayana. And so if I can ask Mr. Sateesh the same question from a PNC perspective, where do you see reinsurance play a role?
Yeah, thank you, Vasan. Actually, the results of the poll makes my answer this question makes my job easier. I am the only non-life person over here. I think all three are life experts. So I'll give it from the PNC perspective and also the Indian perspective. So you all know that the reinsurance ceded premium in India last year was about 90,000 crores. That is roughly about 10 billion US dollars. And most of that premium, about 70% of that was in proportional, that is quota share and surplus and other things. So when you look it from a volatility perspective, that is how you actually are able to contain the volatility. That is the non-quota share. That's non-proportional business is quite small, maybe about 15 to 20%. So in India, at least, reinsurance has been used for more as a more for the growth of the business, growth of the industry. That is why we are going. Obviously, part of volatility is contained in that when you share a significant proportion of your business to the reinsurer. I think about 30% of the non-life premium goes as is ceded to the reinsurers, and being the national reinsurer, GIC Re, we may be writing about, again, 1/3 of that, about 30% of that business, and balance is ceded to the cross-border reinsurers and other reinsurers in India. So from a volatility perspective, how you contain the volatility, I would say it is more of a quota share business, and there are specialized treaties. One of the examples could be like when banks give the loans, home loans, an insurance is attached to it. It's known as long-term housing contracts, where the business is, the term of that insurance is about 20 to 25 years. Largely, that is, it is largely used for the catastrophic protection. So there are specialized treaties, but still, even though the answer to this query says that about 54% of this say that it is for tail risk protection, I doubt whether we are really using the reinsurance as a tail risk protection, especially in the non-life insurance in India.
Thank you so much, Sateesh. And I'll add, probably reinsurance also plays a role in driving innovation, although that's not part of the poll question there. In the next phase of growth in India, there'll be new segments, new needs of the customers, which I can see reinsurers bringing some of their knowledge to help support those growth and those innovation in products and risks. And just moving along, I think the next question for Gaston, if you don't mind. With RBC implementation in the horizon, and you must have seen RBC implemented in various different locations in Asia and globally, what do you think will be the impact on capital requirements, and how can reinsurers play a role to support?
Great, thank you. First of all, thank you for inviting me to join this panel. This is actually my first time ever to India. So it's actually very exciting to be here, particularly at this time, with the rapid growth in the Indian insurance market. And as Sun mentioned, the rapid growth, India is now probably the third or fourth largest life insurance market across Asia. And, we've seen this sort of rapid growth in other markets as well around Asia. So, like China, for example, over the last sort of 20 years, going from nothing to, being one of the largest insurance markets in the world. And I saw from the poll, reinsurance is being, very much viewed as a tail risk protection. And I think that's very true, particularly when an insurance market is evolving and rapidly growing. A lot of capital will come into that market in the form of equity or debt to really sort of fund those businesses and grow it. And then what you're using the reinsurance for is to kind of manage that tail risk to protect your solvency. But as markets mature, your shareholders or your debt holders, are looking to improve that return on the equity that they want. And this is where we've seen reinsurance really playing a role as another form of capital instrument around Asia and the globe. And some of the benefits of using the reinsurance is that equity or debt helps to increase your available capital and provide funding. Reinsurance can do that as well, but reinsurance is also transferring the risk. So you're reducing the amount of required capital that you need to hold. So it provides an additional leverage to your balance sheet at a cost that is less than that of equity. So it's become a very powerful capital management tool that we've seen deployed globally. Now, as you move from a Solvency I framework to an RBC or economic solvency framework, what that really does is, and some of the speakers mentioned this morning as well, you have to move from just calculating your reserves under Solvency I and applying the 4% or 1% capital ratios to actually becoming really risk managers. So you've really got to understand all the sources of capital on your balance sheet. The RBC will highlight, do you have asset liability mismatches, which products are consuming more capital versus other products, or which risks you have more concentration in versus others. And so there's an opportunity within that to rebalance your balance sheet. And we saw that in Europe, for example, when Solvency II came in. You saw a lot of shift in the liabilities being held by insurance companies. So some who are very heavy in longevity risk moved out of longevity risk. Or in Japan, for example, there's a lot of legacy blocks of policies sold 30 years ago at very high interest rates. And as you know, Japanese interest rates have come down. And these books were very low return on capital blocks. So there was an opportunity there to reinsure those blocks, to release that capital, and then redeploy that into newer, higher sources of growth. So just in summary, I think we're really seeing with the RBC frameworks, the reinsurance coming in as another capital tool to help really manage the balance sheet.
Thank you, Gaston. And I think if we looked at the poll earlier, it was quite interesting to see a large number of respondents thought it was more about tail risk protection, but in reality, with RBC2 coming, we'd hopefully see a lot more different use from reinsurers. The next question I have is for Ms. Sunayana. So in the absence of FinRe structures in India, how do you see us using, or the market using, reinsurance for capital optimization?
Yes, that's true. So structured capital solutions currently are not present in the Indian market, and that's because we prefer to focus on direct risk transfer more. But even on these direct risk transfer treaties, and I'll answer this more from life and health perspective, there is so much optimization which insurers are able to carry out. So if you see last 5 to 7 years, the kind of products which have come out in the market. So firstly, protection business, I think there's a lot of focus from government, from regulator also on increasing penetration of insurance in the country. And that can only really happen when the protection business increases. And that is very capital intensive. So by taking on a lot of risk on protection side, a lot of capital gets freed up for the insurer to continue growing their business, be it life protection or health protection. Secondly, there are these new types of disease-specific kind of products which have come out in the market, and that also can be quite capital intensive. Long rate guarantees are also required by the regulations, even on health business. So by having a reinsurer back up those guarantees, the insurer need not keep a lot of capital for the reinsured portion to maintain those guarantee benefits to policyholders. Ultimately, it does boil down to the cost of capital, which is being freed up, versus the cost of reinsurance. But over the last 10, 15 years, many of you who worked in this market would have seen that cost of reinsurance hasn't been as high. And when insurers are in the growth phase, generally it's the cost of capital, that will cost of reinsurance in order to free up that capital to pursue growth. Of course, as companies start maturing, the industry starts maturing, then that is the time when companies will start thinking even more closely about the capital optimization piece and how much to seed and how much to retain.
Thank you, Sunayana. And I'll add, in a market like India where some of the companies are growing at double digits, it is a trade-off between reinsurance, the cost of reinsurance, and of course, the cost of raising capital from capital markets. And I think as the market matures, we will find more structures, innovative structures that's been applied across the globe coming into this market as well. And with that in mind, Mr. Gaston, you talked a little bit about the different structures you've seen at the back of Solvency II and things like that. And I understand you have experience with a lot of asset-intensive structures in Asia. If you can tell us something about those in terms of how you can see them being applied in India, and are there any learnings globally that you think we can apply here?
Yeah, no, thank you. Yeah, the asset-intensive space, I mean, it's been around for a long time, but in Asia, really took off over the last 10 years. And a lot of that was driven, I'd say, by two things. One was the introduction of economic solvency frameworks. So we see in Japan, Hong Kong, Korea, even China, Taiwan, I mean, they're all introducing economic solvency frameworks. So under those frameworks, it really highlighted the sort of the ALM or the market risks that they were holding. And those are very dominant risks on their balance sheet. So there was an opportunity there to kind of really remove some of those risks from their balance sheet and redeploy the capital from those blocks of business into sort of higher return capital business. So we saw a lot of that business take off, particularly in markets like Japan, which has large legacy backbooks. Hong Kong was another market. And just recently, in the last 2 years, we've seen Korea start to use those sorts of structures as well. So that's really been addressing some of the legacy blocks of business and really looking to optimize the balance sheet. The second area that we've really seen asset-intensive reinsurance take off also is in new products. So we've seen, for example, the introduction, let's say, of US dollar products in markets like Japan, Korea, Hong Kong. And those products, it became a very competitive space. A lot of the domestic insurers don't have the same level of capabilities of US dollar investments versus, some of the US players, like RGA or some of the other players. And so it was an opportunity to also use reinsurance to gain access to yield or to alternative assets to help generate more competitive products and generate better returns for the policyholders. So they're probably the two broad themes that we're seeing for asset-intensive reinsurance.
Thank you, Gaston. The next question I have for you, Sateesh. So I've heard some people say reinsurers are really just lending capital for insurers to write business. And so how do you think should insurers view reinsurance structures from a capital first lens and not from an underwriting lens first? How would you go about that?
See, especially in a non-life perspective, if you see, why this underwriting first approach is taken by the Indian insurers and reinsurers is because the current solvency regime basically looks at the premium and claims, that is the underwriting aspects of it. We still don't have RBC in India. Of course, the regulator has come up with RBC. All the Indian insurers and reinsurers have submitted their QIS studies and this thing. But currently, the solvency is measured basically from the underwriting perspective. You write good amount of premium, significant amount of premium. You control your claims, then you become solvent. So there are not many. It doesn't differentiate whether you write the business from USA or India or any other place, the geographical condition or the currency risk. These things are not applied. That is, the risk perspective is still not come into the solvency measurement. So it becomes very simple. The focus is largely on the underwriting aspects of the business. It is more about using reinsurance to make net profit, make net underwriting result, rather than looking at the risk perspective of the business. So what the insurers should rather do from that point is that when the RBC and all comes into picture, they will know that whether the risk that they are taking, whether every premium that comes to you, every business that you write, how much riskier it is. And other point is that reinsurance is not the only tool to control your risk. There are other aspects as well as. So the point is that insurers should look from the risk perspective of the business. Then only they can bring how much capital is needed to write the business.
Thank you, Sateesh. And I agree with that. I think there's quite a lot of considerations and factors that need to be taken into account here, and not just from an underwriting perspective. Switching gears a little bit, so we are all aware of how in the past there's been unsustainable pricing, pursuit of aggressive growth in India and also in other markets across Asia. So with that sort of in mind, so Sunayana, maybe a question for you. When an insurer approaches you with aggressive growth plans, how do you decide whether you're enabling strategic expansion or are you subsidizing unsustainable risk?
I think some lessons are also learned the hard way in this market. So I would say when insurers, and that's a natural part of this market, like we discussed, that it's a very high growth market. There's a lot of competition. There are new insurers coming in even now, and government is, I'm sure there is scope actually for the market to grow further, more insurance companies to set up. But all markets go through cycles, and Indian market also goes through cycles when insurers want to grow aggressively, and sometimes at the cost of sustainability. As reinsurers, I think what we try and do is we try and look at experience which is backed by data. So now that the market has completed, a good amount of time and data is available, it's the responsibility of reinsurers to also use that data to carry out sustainable experience analysis, share those with the client, and explain how we can grow the market more sustainably. Besides pricing, besides rates, there are other levers as well. In a heterogeneous market like India, it's such a large country. The way people eat, dress, behave is different in the north and south, east and west. and also the purchase of insurance is different. The rationale, the motivations, and what we see is there is a lot of difference in the mortality, morbidity experience we see depending upon the location, income, and several other factors, right? So analyzing these trends and sharing those with the insurers helps to put in certain guardrails in place to have a more sustainable growth. When any insurer seeks a quote, actually, the standard practice is to go to a number of reinsurers. And ultimately, business may be placed with only one or two reinsurers. But the advantage of this process is even the reinsurers who are not ultimately going to cover the risk would have shared some insights, some experiences with the insurers, which may give them some points to think about. And coupled with the insurer's own operational and strategic insights, right, this growth can be done in a more sustainable way. Lastly, there's also once a reinsurer is on the books with an insurer, typically reinsurers carry out certain reviews, underwriting practices review, practices of claim settlement, and share best practices with the insurance community. So this also helps to put in some place of guardrails. Ultimately, growth is good, but unsustainable growth is just a long-term, leads to a long-term decline in the industry, and it's a systemic risk. So this is a very important question, Vasan.
Thank you, Sunayana. I couldn't agree more. So I think we've seen this happen time and again across different markets where in the pursuit of growth, we sometimes close one eye and take on risks that are unsustainable, but the results are always the same, and we always end up in the same place where we'll have to unwind, and there's market correction, and ultimately the people who pay the price are the policyholders, which is really not what we're here to do. We're here to provide protection that last generation. So it's very important that we make sure whatever we do, we have a long-term view in mind, and products we launch, the risks we take, really stand the test of time. The next question I have, I would really like to have the views of all three of you. So what capabilities do you think reinsurers must build to remain or become strategic partners, not just capacity providers? Maybe Gaston, we can start with you.
So I think for reinsurers, I mean, some of the capacity to build, I'd say there's a few things. Particularly as we see this sort of evolution into the capital management. So one is, being still very strong on the underwriting side and building those capabilities on sort of the various biometric risks, like you mentioned, Sun, in the Indian market. Because I think reinsurers are often a good barometer of what's going on in an insurance market. So if none of the reinsurers will reinsure a product, I think that starts to give you a warning signal in terms of the sustainability of some of the insurance products and vice versa. And then I think some of the other capabilities that we're sort of building on as well is really around the asset side of the balance sheet, so that we can bring together both the asset and the liability side together to help bring much more holistic capital solutions to the insurance companies.
Maybe I can go next. I have 2 points to add to this, Vasan. One is on automation, right? So automation of technical underwriting. So did you know that when you go to buy an insurance policy, many times you are subject to medical tests, and those test results are then screened by an underwriter, a human underwriter, who decides whether the policy is to be issued or not. This entire aspect has been automated by a number of reinsurers, including Swiss Re. And this kind of automation can play a very big role in growth of protection business and growth of any insurance business in this fast-growing market, and that can enable a lot of growth in strategic partnership with the companies. The second point I have to make is around data. While we have very solid industry associations like IIB, I think even reinsurers can play a very pivotal role as independent third-party consumers of data, right? So you take data from a number of companies, pool it together, and then share those very specific insights with insurers to direct what kind of growth should be carried out what kind of pricing, what kind of underwriting, tailored and customized risk selection, because that is the stage of the market that we are in now.
I'll just add a couple of points. You have used the apt word is a strategic partner. The reinsurer can act as a strategic partner in the sense that the reinsurer knows the global market. So I'll just give you with an example. 7 years back, I was tracking about 7 catastrophic events. Today, I am tracking about 70 catastrophic events. So I know how the cat events are emerging across the world. We were maybe about 5 years back or 6 years back, we just had one-off catastrophic event in India. Now, every year we have a 1 or 2 cat events in India, and we are managing that. So be a strategic partner to the direct insurers. You can also bring them we know how market hardens, when the reinsurance market softens and things like that. So being a strategic partner, you can actually pass on this information. I would say, internally I say in my company, be a big brother to the direct insurers. And also, the reinsurer is better placed to actually mitigate or manage these risks. So one point is more the information part and hand-holding the companies, because we are discussing this point from a 2047 perspective. And 2047, when we say insurance for all, we also need to consider how the reinsurers are going to support this government initiative or India's initiative. This is going to be multifold. Currently, the non-life insurance is growing at maybe about 10 to 11% CAGR. This growth is going to increase in the coming years. So the reinsurers should be ready to actually handhold the direct companies. Also, India, the 100% FDI is also coming. More insurers will come. They will. It would be like the best word to use is that only be a strategic partner to the direct insurers and help them mitigate that risk.
Thank you, Sateesh, Sunayana, and Gaston. So I agree with all the points that have been made, and I would like to double down on, reinsurers. We are pretty much a service provider here. So we support the insurers to grow. We support the population to get the right level of protection. And in order to do that really well, we must provide the top level service, be the subject matter experts, be able to provide consultative services to advise our clients, our insurers, how to go about doing things effectively, efficiently, to provide coverage for the most people that we possibly can reach. And Sunayana talked about automation. I'll also like to double down on that and take it a step further. Technology. So through the various technologies and systems that have been supported by reinsurers, and for Pacific Life Re, we've got Underwrite Me, AI models, and so on. I think this is where reinsurers come in providing the right level of service to enable the growth of the insurers in the market. We've got 7 minutes left. I think we'd be happy to take questions from the audience if there's any. Maybe we'll look. There's one question at the back there. Can we pass a mic to the gentleman at the back, please?
Thanks all the panelists for such an insightful session. This is Hemant Kumar from Principal Global Services, Pune. So my question is to Sunayana regarding automation on accelerated underwriting. It started maybe 4 or 5 years back, and in the US, the experience has been that the difference between manual underwriting and accelerated, there is a term called mortality slippage. It's around 13%. The gap between the underwriting results done manually versus through AI or automation. Has there been such experience at Swiss Re? Is there anything that you are doing to avoid such situations or handle this situation?
Thank you for the excellent question. So, yes, I would say there's been a definite improvement. The kind of solutions and maybe I will answer this more from perspective of my company because I'm not privy to the kind of automation technologies being used by other reinsurers. But generally, these kind of technologies are developed together across the market. So I'm sure even at other reinsurers, things would not be too different. So AI, it's not, we are yet to reach the stage where AI is being used to do a lot of the underwriting. So as of now, the example that I gave refers to this, okay? So after you go through the medical tests, generally you get a digitized medical report from the vendor. At times, the reports are not digitized, in which case OCR, optical character recognition, is used to digitize the medical report. And that OCR technology is also not perfect today. Okay? So there is some slippage over there. But ideally, more and more of the larger medical test centers are moving to digitized reports. These digitized health reports can then be fed into a system in which the reinsurer's underwriting manual is already fed into the back end. Now, for a human underwriter, the person would have to log into the system, look for that particular result, okay, whether it's diabetes, whether it's a lipid profile, whether it's a kidney issue, and then give a certain rating, and then an underwriting decision. We are seeing about 80 to 85% of these test reports can go through the system in which the manual is fed into the back end and automatically the decision is being given. 15 to 20% cases are slightly more complex and require a human intervention. So I think the key aspect here is that automation cannot solve for 100% of the cases. And the crucial point is to differentiate between what is good enough, where you're really confident of the results through automation, you keep the tolerance limit at that level and pass through the system, where you are seeing 99.98% accuracy. And in fact, the accuracy is better than passing it through human underwriters. And we should be mindful, and the crucial part is to be mindful of those complex cases which still automation lags behind and requires a human underwriter, a specialist underwriter's intervention. So if you're able to make that distinction correctly, you can get very good accuracy with automation, even better than the human system.
Thanks.
Hope that answers your question.
Yes, thank you.
One more question here in the center. Sorry, there's one more question right in the center here. Thank you.
Thank you very much for a very informative session. I am Atul Malik from Aeon and wanted to understand, because we have been doing the solutioning for reinsurance pricing, where technical prices were, as Sunayana suggested, on the experience we have already established very nice methods and do very perfectly. And we are already trying to put the AI on top of it to do the contextual pricing, because that information is not very well structured way available to us, and then the solutions will be coming. But then the question is about, now there are alternative ways of transferring the risk than the reinsurer. So what do you expect from us to provide you within those solutions or extension of those solutions, so that we can help you even finding those alternative methods where this risk can be transferred equally to the reinsurer and the other options, basically. So what is the expectation from the insurer side on that?
So I think the question is, if I can repeat, what are the expectations of reinsurers in a world where there are alternative risk transfer approaches? Is that right?
Yeah, exactly.
Okay. Maybe I'll give it a go, and then one of you can supplement. So I think the expectation still hasn't changed from the past, where reinsurers will want to understand the risk. Reinsurers will want to understand what exactly you're trying to achieve. And a lot of times that's whether through communications of, transparent communication of, here's the problem to solve, here's the data behind it, and so then a very clear judgment call can be made in terms of what the risk exactly we're taking on board, and also ensuring there's alignment of interest. So pretty much there's a few things that we look at which to me will not change. What will change is the innovative ways in which we provide the solutions. That will continue to evolve, will continue to change. I think Gaston mentioned it very cleverly earlier just now, where once we start looking at your balance sheet and once RBC comes in and once your capital positions move, the solutions will start changing. But the way we approach it may not change too much, but with AI coming in, there will be some shifts, but at the end of the day, do we understand the risk? Do we understand what we're getting into? And how do we get comfortable that and we put the right amount of capital behind the risk we take? So that, I hope, answered your question, but I'll open up to the panel here.
I'll just like to add here. See, reinsurance is basically a long-term relationship. It is not just something you come here, I give you a solution, you make profit, I make loss, and we part ways. No. This is a long-term relationship. So we both should understand the risk better. And like you said, there are certain parts of it which could be reinsured, which could be some of the risk, which could be for which reinsurance is a solution. And there are certain parts of the risk where reinsurance may not be the best solution. There could be other alternative solutions. So best agree on that and go ahead and move with that and maintain that long-term relationship. So that will actually help you drive your business, and on a long-term basis, that is what is going to help.
Yeah.
Thank you. I think our time's up. So just to end today's session, I'd just like to reiterate that reinsurance is not just purely a risk transfer tool, it's a strategic lever. And if the next decade is truly going to be volatile, reinsurance will not be peripheral, it'll be central. It will not be just a technical necessity, it'll be an engine to drive growth. And with that, I'd like to end by thanking our fellow speakers on stage for not just sharing their insight but perspectives. I hope you all took away a lot today, and I hope you enjoyed the session. And thank you to organizers.